Good evening, everybody. We will be getting started very soon here. I'm just preparing some last things. I originally wanted to create a whole PowerPoint behind today's class. However, um, I unfortunately did break my hand earlier, so I'm for sure broke at least two of my fingers. The third one, I'm not sure yet, but they're all wrapped up. Um, yes, it will be recorded, so if you can't stay for the live class, that is not an issue at all. I will be keeping this on the channel. It will be free, and um, eventually I will be able to splice it up a little better so that there won't be breaks or anything in between the actual class. But with that said, just a few minutes, everybody, and we will get started. But I did have a little bit different plans with how I was going to set up the original class today. Um, with that said, we will be still going over the same things that I originally wanted to go over. So, with that said, give me just about 2 minutes to set some last things up, and we'll get started. All right, everybody, let's go ahead and get started. Now, I am going to type some things on screen very quickly before we start, just so that we can all be on the same page of what we're actually going to be going over tonight. And I will get rid of the logo and everything in a minute. It's gonna look messy for a second. I do apologize. I have not had time to edit everything ahead of time. I did break two of my fingers this morning, so um we do have to contend with that. Other than that, everything will be. And if there is any questions during this at any time, feel free to go ahead and ask, and I will circle around to the question when I do get a chance to look at chat. Okay, so this is what we will be primarily going over tonight. So if you want to write this down, great time to do so. But it will be a fairly simple lesson tonight. We will be covering the full totality, though, of the moving averages. Now, this is specifically the SMOS, and in different brokerages and different charting programs, they may be labeled different things. I've seen it be labeled the DMOS, which is the daily MOS. I've been seeing it labeled just the MOS. We are specifically not using the EMAs, which is the EMAs. This is specifically the ESMA, DMA, or the MA. Okay. Um, be very, very specific about that. We're not trying to use any um, moving averages that are based on estimates or anything. So with the Bollinger Bands, I will be going over the settings and why they are set that way, and how we can use the Bollinger Bands on all of the time frames. And that does kind of segue into the next point, is that how we can use all these different tools on each time frame to make very, very accurate trades. And I'm going to be discussing the daily 5 mile weave. I said 5M. Let me go ahead and edit that for anyone taking pictures or anything. The daily 5 mile weave, which, just to put it very, very quickly, it's when the movement between each level is taken. So if I'm at the upper Bollinger, the next level I should be expecting should be the 5 mile. After the 5 mile, if we're going to be heading down to the 10 mile, then I should be expecting a move down to the 10 mile, and then the 5 mile retested again, so on and so forth. So I will be explaining that in more detail. With that said, happy Easter, everybody. Thank you for joining. Do apologize for starting a little late. And just to say this one last time, tonight's session isn't going to look perfect just because I did break a few of my fingers earlier, and it's going to be a little difficult to navigate everything with that. So um we will still be going through everything with that said. Okay, so moving averages. On my settings, and I want you to forget the majority of these settings right now. But on the daily time frame, and let me just make sure this is pulled up. On the daily time frame, and we're going to very specifically be going over the 5 mile currently. So I want to make sure this is a very thick line so that it is easily seen. So any of the moving averages on any time frame can be summed up to an iteration, or how many iterations are going to be taken on that time frame. So if I am trying to track the 5 mile, that means I am expecting 5 iterations on the daily time frame. That means 5 days. If I'm tracking it on the 1 minute time frame, that means I'm expecting 5 iterations of the 1 minute time frame. So that's basically 5 minutes. If I'm expecting it on the 5 minute time frame, that's 25 minutes, because that's going to be 5 different candles. So the 5 mile on every single time frame will be expecting within the 5 previous candles. Okay. Same if I'm trying to track the 10 mile on the daily time frame. This is a level based off of the last 10 trading days, and I will go into that a little more detailed, but that's how each level is read. So if it's the Ma 5, that's tracking off of the last 5 days or last 5 iterations. Same with weeks. If you're looking at the 5 mile on the weekly time frame, this is going to be going each week. So this will be a sum of 5 weeks. Same with months, anything else like that. So what is important is that with each of these levels, we're trying to determine very key trends. Now, for my levels, I specifically track the 5 mile, and I'm going to set these a little bigger just so that they are very easily seen tonight. And the primary ones I track, and you can track some other ones, but I'm going to describe or, tell you why I track these ones specifically. But I track the Ma 5 or the 5 Ma. This is a sum of in the daily time frame, a week worth of trading because the standard trading week has 5 days within it. So this is tracking 1 week, the 10 ma tracking 2 weeks, 20 ma tracking the month. Generally, there's about 20, roughly 20-ish trading days within the month. So this is giving you the weekly, bi-weekly, the monthly, moving averages within that time frame. Okay. The 50 ma, this is tracking the quarterly. So, um, based off of the daily time frame, the 50 mile would be roughly about 3 months, 4 months. So not exactly within that quarter time frame, but it's cutting it very, very close. Now I know some people will track the 100-day time frame, which that's more so a lot closer towards that 4 to 5 months range. There's nothing wrong with it. It's just something I specifically don't look for. And the 200 won is essentially the yearly time frame. So this gives us a wide range of, weekly, bi-weekly, monthly, basically quarterly, and then annual. So it gives you a very wide range of being able to track what the prices are doing over that period of time. Now let me go ahead and just look over the comments. Okay, so no questions yet. Now, with that said, the 5 mile will always be our closest level, or depending on whichever moving average you set closest or to the lowest number is going to be the one that the market will most averagely or be gravitating to on average most of the time. Now with the 5 mile, again, it's tracking the 5-day moving average, so it's tracking the last 5 sessions. So we're generally going to be trading around where the 5 mont is very often. It's basically saying that we should be seeing this level once a week. So if we're underneath this level, meaning if the market price is underneath this level, then if we haven't tested it within a week's time, where should we be expecting the price to start gravitating towards? That's right, towards that 5 mont upward. Same goes for if the price is actually above that 5 mile range, then we should be expecting the price to gravitate downward towards that 5 mile because on average, the 5 mile is tested once every week. Um, that that is specifically why it is the 5 mile. So on the daily time frame, we can use our 5 mile as basically an anchor to really determine where safety is, whether we're having a major crash to the downside or some massive rally to the upside. We can always really look towards the 5 mile to be a range of, you know, that's somewhere we're generally going to be trading at again. Even if we push up very aggressively, we can expect to pull down slightly to consolidate towards that 5 mile. Same if we, have a very, very massive pull to the downside, we can expect to start pulling upwards slightly to consolidate to that 5 mile because the market wants to gravitate towards that range once a week. Same for the 10 mile, same exact thing, all except instead of every single week, this is going every 2 weeks. So if we're above or below this level, every 10 trading sessions, we should be trying to look for this level to be tested. Same for the 20 month. Once a month roughly, we should be looking for this level to be tested. So these give you very, very easily defined ranges that you can, you know, very, very accurately and historically look towards. Again, the market, whether we're pushing upward or downward, it wants to trade at these levels. It's not really outside of these ranges very often, besides some of these longer moving averages. So this is a range that the market wants to gravitate towards. So we have to use that to our advantage. If we know that, again, we're going to be testing the 5 mile once a week, then we can set up positions on that, if we're expecting this range to be tested once every 2 weeks, we can set positions with that. Same with the 20 mile, same with the 50 mile. Now with the 50 mile and 200 mile, because we don't specifically head to those levels so often, compared to like the 5 mile, 10 mile, 20 mile, I use these more as trend indicators. So if the market price is actively trading above the 50 mile, then to me that's a bullish market. Okay, that's telling me that there really isn't a whole lot of resistance to the downside. We're really not seeing a whole lot of selling. If we see selling to that range, are we going to see it start having contention to where we see the market pulling below that for a long period of time, or are we going to see it bounce from that range? That's how I like to read the 50 MA is essentially not really a range to be tested, but a range to look for as a shorter term indicator of the overall trend. Now, the 200-day moving average is sort of the same thing, well, except obviously a longer moving average. So once we start pushing this 200-day, I don't really expect a bounce right off that level. Now, some stocks will do that. They will trade right to the 200-day moving average and almost to the penny bounce upward, and then you won't see that for another half year to a year. Um, that's not really what I expect out of the 200-day moving average. It's more of, again, a very, very long-term trend indicator to tell us that are we going to be trading in a bullish range where we haven't really seen major selling for roughly a year? Or are we going to start trading underneath this range where we're seeing more selling than buying on the year? So it's a very long-term indicator, not so much something that I expect to be fully tested. Okay. Now, moving on to the next section, and I will be going back to the moving averages, but I do want to start talking about the Bollinger Bands. Now, the Bollinger Bands work a lot the same, or work a lot like the moving averages, and I do want to make these a little thicker just so that they're easily seen tonight. Now, my settings for the Bollingers, again, are the length of 20. Now, whatever you set this length to will be essentially setting it to that moving average. So if I set the length to 5, this is setting it to the 5 iteration moving average. If that's on the daily time frame, that would be tracking the 5-day moving average, and it would give me much more shallow moves on the upper and lower Bollinger. On the 20-day moving average, this is essentially saying that we are expecting this range within a month. Um, that gives us a very, very well-defined range in all different types of time frames to be able to use the moving averages and the Bollingers, very effectively to be able to tell us the real, um, you know, outsides of these ranges aren't going to be taken too much. That's really what we're looking for those Bollingers to tell us. And with the Bollingers tracking the 20 mile, it really gives you that depth and range to the move. Now the width, this is tracking the volatility on the move. Now I don't remember the exact percentages, but with each one digit. So if it was set to 1, this is tracking a lower volatility than set to 2. At 2, it's set, I believe, to a 95 or 96% volatility move, meaning that this is really trying to track the volatility within the market. This is really trying to say that once the market's at this 20 month, potentially we could see this move all the way to the downside, or we could see all the way to the upside here. Can we see above that? Absolutely. But we can also see below that. This is really just trying to open up those ranges to tell us that this is a level that's on the table currently, based on all the volatility that's currently being tracked. So that's why I like the width at 2. If you want a much more wider Bollinger, then you'd set it to 3, and that's basically tracking, I believe, like a 99% move. Not really what I'm looking for. Now you can set it to the 3 to really track basically the very, very bottom of these lower Bollinger or the upper Bollinger pushes. But again, that's not really the goal of what we're trying to accomplish here. This is the SPY. Um, and then this can be done on any single symbol. If you want me to go to the SPACs, I absolutely can. Um, but this is what we set for the Bollingers. And again, just to double confirm that we are tracking the 20 mile here, um, it will be harder on your screen to zoom in here, but I want you to look at the 20 mile and the mid Bollinger here. They'll be the exact same level. So here they're currently 658.09. So that's telling you that within the Bollingers here, this is tracking that 20 mile. So it does play into our moving averages very well, and it also gives us a visual way to identify that we are still within the range of, that middle Bollinger. Middle Bollinger being the 20 mile. That's a range that's going to be contested roughly once a month, and that's a very, very strong level to look for. Now, on the 5 minute time frame, and we're going to be swapping to the 5 minute time frame here for a moment, is that the reason why I want to bring that up is because I use the 5 minute time frame for doing my day trades very, very often. So I do want to go to an active trading session. And again, within the, I don't like that session. Let's do, yeah, let's do this one. Okay, so within the 5 minute time frame, remember that the middle Bollinger slash 20 MA is tracking 20 iterations of the 5 minute time frame. Okay, so that's a fairly long period within the trading session. Now, can we push that level multiple times during that trading session? Absolutely. However, we should really be expecting it again to be hitting that level once every 20 iterations of these candles. Not that I'm going specifically to count candles, but just off of the top of my head here, if, for example, we started the trading day at this yellow line and say we start pushing upward into the upper Bollinger, we know that, okay, we're really not near this 20 mile yet. We should start expecting to push towards that 20 mile. Well, even at this range right here, we did not push the 20 mile and start pushing upward. Well, that looks to be about 20 candles worth. We should really start expecting a 20 mile push. So it's a range that we can really gravitate towards because it's the most neutral range that you can have pretty much on any time frame. Whether we go to the 1 minute time frame, you could literally go to the 1 second time frame and see this exact same thing. But the market is really trying to trade above or below this range on average, and it's always going to be trying to retest this range to really set the trend of the day. So if the trend of the day is going to be bearish, it likely wants to test above that and then start trading below that for a large majority of that day. Okay, unless it's trying to claim liquidity above that. But it's a very, very good indicator on any time frame. Okay, and again, any time frame, you will see this exact same thing where the market really gravitates towards this 20 mile. So on a daily time frame, That's a very key level for us. Okay. Um, we will circle back to that because I'm not going to be fully covering that right this second. But in conjunction with the lower and upper Bollinger, the 20 mile is really how you get the upper and lower Bollinger to start moving. Okay, and that's why we really had to discuss it so much. It's a very key level. But once we start having this pulled downward, we will see the Bollingers start pulling downward in total. Okay, in totality, essentially, because the Bollingers again are really tracking the volatility around this 20 mile. If we start seeing this push upward, then we would see the upper Bollinger start opening to the upside. Very, very likely start seeing this lower Bollinger expanding slightly to the downside and it really opening up that volatility to be able to trade between a very large range. Okay. Um, when we see the Bollinger Bands very consolidated and tightened, that means that the volatility isn't extremely high. Even though we're seeing a lot of selling, um, don't really take volatility as the word for um selling because I know a lot of people think that volatility is just for selling, but you also have negative volatility which leads to buying. So volatility goes both ways, and with volatility going both ways, we do see that flattening on both ends. For example, while we see the bearish side up there, we do see the bullish side in here, where really there's not a whole lot of volatility selling to the downside. So there's not a whole lot of room to be pushing below that. We're going to be pretty much keeping these ranges very, very closed and tight and continue heading up to the upside. We get in here, we start seeing not only the upside Bollinger, which is really a upside volatility level tested, but we also see a lower side volatility level tested, which that then really tells the market that, okay, this whole range in here is now open. And I'm going to go ahead and delete this circle and delete this circle. But once that range starts closing, once we start creating this major consolidation range right in here and stop trading at that level, what happens? All of a sudden, the Bollingers start closing up, closing up, closing up, and all of a sudden, the volatility is telling us that pretty much we're going to be selling to the downside. So the Bollingers move in tandem with the 20 mile. If the 20 mile generally is going to be pulling downward, you will be seeing the Bollingers in totality moving downward. If you see the 20 mile pulling upward, you will see the Bollingers in totality pulling upward. Okay. Now, if you see very large moves within both the Bollingers within that reasonable time frame, which for the daily time frame, we're really attributing that towards that 20 ma. That's really that neutral range. So if we start seeing large moves up and down between the lower Bollinger and the upper Bollinger here, what that would do, even if the 20 mob wouldn't move a whole ton, that would start to expand the upper Bollinger to the upside, and it would start to open the lower Bollinger to the downside because this is showing that volatility is starting to really pick up, not just in the negative sense, which negative being bullishness in this aspect, but to the positive sense too, towards that downside. So the Bollinger Bands really do tell us a whole lot about where the direction of the market is going to be going. And another thing that I want you to think about with the Bollinger Bands, and very quick before I jump into that, I do want to check if there's any questions. No questions yet. Okay, so everything's good, all the audio's good and everything. Great. All right, so one thing I do with my Bollingers, and I very, very specifically do this, is that I make it look like a road. And I know that's going to sound ridiculous. However, assuming that this was, a yellow line in the middle, for the 20 mom. I personally just really enjoy my 20 mom being at the or being purple. It works very well for me. Um, but I have my white lines on the outside, and this is telling me that if I start getting off the road here, if I start getting off the road here, what's likely to happen? Well, we know exactly what's going to happen. The market generally doesn't like to trade off the road for very long. When we get off road, the market likes to say, nope, I should not be there, and I'm going to head back on the road. And so that's what we expect both on the upside and the downside. Is that once we start seeing, and I do apologize, it's a little hard to see some of these moves outside of the Bollingers because I have the Bollingers expanded currently. But once we start hitting the upper or lower Bollinger, that's really beginning to tell us that, okay, we need to start backing off that level because very, very likely we're going to, once again, head back on the road. And this goes for every single time frame. It doesn't matter if it's the hourly, it doesn't matter if it's the 1 minute time frame, it doesn't matter if it's the 1 second time frame. Um, all of these levels and all of these technicals will still try to trade the same way. So one good example here, and I want to show you is, and I believe this was Wednesday's session, if I remember correctly, is that on the 5 minute time frame, we can see how within the Bollingers here and with them expanded, so I can't exactly see each and every single move, but we see how it traded to the upper Bollinger there, set the lower Bollinger there, stuck to the lower Bollinger there, and I do want to circle each of these 20 moves because I'm going to show you what this looks like on the 1 minute time frame. And a lot of these moves are also going to be upper and lower Bollinger moves on that 1 minute time frame. So we're going to circle this one. Okay, so let's go with that. And I do apologize, not the most perfect circles. Let's go to that session. Okay, and I am going to shrink the Bollingers down just a little bit so that we can actually see what's going on here. Okay, so here is the 1 minute time frame. And again, we circled on the 5 minute time frame the lower Bollinger moves, which I want to actually mark in red to signify the selling. The upper Bollinger the green signify buying, purple being the 20 mom moves. So what we see on our time frame here, and very likely this 20 mom was right there, but within the 1 minute time frame, we see that on the 5 minute time frame, we push into the lower Bollinger. On the 1 minute time frame, it gives us that move very, very briefly and starts pulling all the way up to the upper Bollinger. From the upper Bollinger, starts pulling down to the lower Bollinger, crossing through the 20 mile. From the lower Bollinger, starts pulling back up towards the upper Bollinger. And within the 5 minute time frame, this is the first time the market price is actually pulling through its 5 mile or its 20 mile range. So it's starting to head to the upper Bollinger. Meanwhile, we're seeing within the 1 minute time frame, upper Bollinger, back down, heading to retest above the 20 mile, back down, upper Bollinger, back down, upper Bollinger, lower Bollinger, upper Bollinger. So you can see how within the multiple different time frames, it will continue to do that exact same pattern of trading from the upper Bollinger to the lower Bollinger, setting the trend. So we can use our different time frames in conjunction with each other. So for example, when I'm starting to test the 20 mile on the 5 minute time frame here, well, I see, okay, my 1 minute time frame is telling me that actually we're going to be moving up here. It's telling me that the downside is really fairly pushed off off the side of the road, and that we should be expecting that upside. Well, what does that upside mean on the 5 minute time frame? And I do apologize, I have to circle back to these each and every time. But on the 5 minute time frame, that'd be showing that very, very likely we're not just having a small bounce here off the 20 mile, but very likely we're heading all the way to the upper Bollinger. So that's a very, very strong tool. I should circle this as a upper Bollinger move on the 5 minute time frame. So it's a very strong tool to be able to correlate the multiple different time frames together. Um, and also, for example, and I want to delete all the drawings again. Say we're expecting a 5 mile push to the upside on the daily time frame. And I don't know exactly where the 5 mile is in this current picture, but we're just going to assume that the 5 mile is right around that 657 range. Okay. So that's going to be that daily 5 mile. Well, what happens when we see on the 5 minute time frame that we start building this head and shoulders? Well, very likely that's going to lead to a major gap down. Okay. From that major gap down, that's a rejection of that 5 mile on the daily time frame, which very, very likely would be pushing us into the lower Bollinger or something like that. Okay. Happy Easter, everybody. So, is there any questions about the moving averages or the Bollinger Bands before I jump into um, what we're talking about next, which is, kind of going over how to use them in each time frame, but I'm going to be discussing the 5 mile weave in conjunction with this. So I'm just gonna mute for a couple seconds here, wait to see if we do have any questions, because I know I covered quite a lot in a little time. All right, again, if there's any questions, feel free to type them out and I'll be happy to go over them. But I do want to just show some more examples of this. And if you have any stocks you want me to look at, I'll be happy to look at them very, very quickly. But let's take Apple and let's go ahead and delete all of the drawings here for a moment. This is the daily time frame. And what do we see out of Apple? We see how back in December, we started pushing in the upper Bollinger. From that upper Bollinger push, we see that we start heading off the road. And what happens? We head back onto the road. Okay. And I'm just going to continue labeling a few of these here just to really show. Now this one, it pushed upward, did not gravitate up a whole lot, but again, I will explain that with the 5 mile weave um, coming up in a few minutes here, but just to show the lower Bollinger and the upper Bollinger moves. Sorry, I can't talk very well tonight. So we can see that the market is constantly gravitating towards this 20 mile. Anytime we head off that road, we should be expecting to start heading back towards that range again. Okay? And this is something again we could see on any single symbol, any single time frame, and just going over Apple's time 4 hour time frame, doing the exact same thing here, just very briefly. Again, we see for Bollinger 20 mile, Bollinger 20 mile. For Bollinger to the 20 mile, Bollinger to the 20 mile, and I will get the lower Bollinger moves in just a second here. Bollinger to the 20 mile, lower Bollinger to the 20 mile, lower Bollinger to the 5 mile, lower Bollinger to the 20 mile, lower Bollinger towards the 20 mile, not fully hitting the level, and lower Bollinger move. Okay, so we will just make these red to make it a little easier to see because the purple is just not jiving with me very well tonight. As you can see, the market on every single time frame is going to be trying to gravitate towards that 20 ma. If you see it push off of the upper Bollinger or lower Bollinger, the expectation should truly be that you're only going to be there very momentarily. And again, that's why I like that reference or, to think about it in my head as a vehicle. Once you start going off-roading, might be fun for a little bit, but generally you want to trade on the road. Um, Second you get off that road, might be there for a little while, but the whole goal is to get back on the road again. So that creates conditions where within the upper Bollingers, we can create short positions. In the lower Bollingers, we can create bullish positions to the upside. So that allows us to open up a lot of different trades. Again, we can use multiple different time frames. So for example, if you want to super long short this, right? Say you want to short Apple, just for 2 years out, okay? Well, back in what was this, January or back in December, you would have opened puts, and what would you expect? Well, we were within the upper Bollinger. From the upper Bollinger, we should be expecting back towards that 20 mile because generally you don't continue to go off-roading for a very long time. We're already seeing each week starting to slow down a little bit within that buying. So the expectation should really be to start pushing down towards that 20 mile. Well, what does this look like in the weekly time frame? Well, within the weekly time frame, that looks like almost an upper Bollinger push towards the lower Bollinger push. So again, that's a huge amount of trade. That's over $40 of lost value there in terms of, or $40 of movement in terms of Apple. And then in the daily time frame, sorry, I'm struggling with my mouse a little bit. I only have one finger. I did break some of my fingers earlier, so that's how it goes. And on the daily time frame, this is showing us. Sorry, it's really hard to move my mouse. Gosh, I'm gonna have to do this with two hands. And on the daily time frame, it's showing us that upper Bollinger push, not only to a lower Bollinger push here, but again, starting to recreate the conditions for another lower Bollinger push. The indicator at the bottom is the ADL. It does not work like the RSI at all. Um, you can think of it as a bank account. So if you see it moving upward, then funds are being put into this symbol. If you see it moving downward, funds are being withdrawn from that symbol. So it works very nicely on many different time frames. It tells you a very clear picture of whether there's buying or selling. For Apple, and this is on the 30-minute time frame here, and this was Thursday's session. You can see almost the entire session. We just start buying up, 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 and then at the end of the day, see a massive candle to the upside, and that's all she wrote, right? So ADL, very good. Um, but let me go ahead and look at chat for a second. How do I identify trends? Yes, those are volume bars at the bottom. Um, I don't specifically look at the volume so much, but it does kind of give me a decent, little glance to look at visually if I see a very low volume day or an extremely high volume day. Generally, that's something to take a look at. So, um, That's very nice for me personally, but I don't really use the volume in that sense in 5-minute scalps, for example, unless we see some super large candle to the up or downside that really is outside the norm. Now, there was a question here about how do I identify trends, and this is ideally the whole goal of this, so that's a perfect question. And I do want to just adjust these really quick so that we can see. Okay, and I want to go back to the SPY here. So how do we use these both to identify trends? Okay, we're going to go to the daily time frame to do this, and for this, I actually just want to hide the Bollingers here for a moment. Now, if I were to just look at the symbol, you know, not having traded it before or anything else, let's go to some symbol that I've never traded before. Traded the most on my list. Hold on. Give me 1 second. Let's say NXPI. That's been one I haven't traded in a long time. Okay, so if I were to just look at this, if I had all my moving averages and Bollingers and everything, looking at this on the daily time frame, well, it's like, geez, how do I even begin to identify a trend? Well, we start from the longest trends to the shortest. Okay, so even though we look when we're actually trading, we look for the anchor point, which is the shortest trend, to determine where our short-term price is going to be heading. For the long term, we look for our very, very long-term anchors. So with this symbol, we see that on the 200 mile. Okay, so that 200-day, roughly 1 year moving average. We see that, okay, we were trading for above it for a few months now. Sorry, that was supposed to be a circle, but cannot move my hand very well. So janky circle, but we were trading above the 200 mile for a few months. We traded below it a few times, and I'm going to delete that previous circle. And now currently we're below it again. So what is this telling me? Is that one, either we're going to be seeing some major downside because we are starting to see our price really gravitate below this level, or two, we're expecting another bounce to the upside. Because again, within the last few months, it's been showing us that every time we get to this level, we see a bounce. Now, in the grand scheme of things, that hasn't been the whole trend with this symbol, but just looking at the last few months and looking at where we're at now, we do see that the market price is below the 200 moving average. We see that the shortest term moving averages, which again are our absolute closest anchor points, the 5 mile, the 10 mile, the 20 mile, all below our 200-day moving average. So that marks it either as bullish or bearish. Okay, and we make it very, very simple here. And I want to see if I can write something here. Hold on. And as long as we're below the 200-day moving average, I didn't mean to make a note, meant text. And we'll say 200 mile. Okay, because we will just identify each of these to make it really easy to show you this example. So bear trend 200 mile. Okay, so on the 200 mile, we see that we are well within this bear trend. We see that not only is the market price, but all of our short-term moving averages are in this bear trend, and our, roughly quarterly moving average is starting to enter this bear territory. Okay, that's not good. That shows us there's a lot of bearishness. So let's mark these in red for a moment to show that these are the 200 mile. Now let's go ahead and do this again with the 50 mile. 50 mile. So bull trend 50 mile. Oh, I didn't mean to press tab. And I know this might seem counterintuitive when the price is all below this very greatly. However, um, it is important to mark each of these levels because sometimes you can be in a bear trend in one and a bullish trend in another. This example doesn't exactly show that, but it showed it for a period of time where at this point we're seeing yes, the market price is well below that. However, with this starting to pull downward, we can potentially start seeing the market gravitating up towards that price as long as there's been roughly 50 sessions. Now, has there been roughly 50 sessions since that point? No. So, with this example, we are expecting that, roughly quarterly trend to start pulling below and to really set us into multiple bear trends. Okay, so we're within an annual bear trend and we're within a quarterly bear trend. Okay. So the trend overall is telling us that we are within a bearish trend. Okay. Now, using these tools with our Bollingers, we see that, and I do want to draw a couple boxes here for a second because I do think it'll be a little easier to see. So one moment, do that. Just one second. Let me grab some coffee really quick. Yeah, we could take a look at Micron after this. That'd be great. Okay, so I'm going to move bear trend signals over or signs over just a little bit, bull trend. And here's something that we can just do very, very easily. And how did we set these levels? Well, our market was trading at these levels, both to the downside and the upside. So we see within our bearish trend, and I'm only going really to right here because starting to pull this back below that or back further would cause this 200 mile trend to change slightly. So I really just kind of want to pull it to right there. This is telling us that within the current time frame, which on the daily time frame, we are seeing that our volatility expected moves, which again, those are what the Bollingers are really telling us, are telling us that even with heavy volatility, we're not expecting to push to the upside in any major form just yet. Okay. Can we start trading a bullish trend? Yes, and I will go over that in the shorter term trends in just a second here. But within a longer term trend, this is telling you we still have a lot of downside here. We still have, even if we start pushing upward and claimed this upside volatility, we still have to start pulling all of our moving averages and everything above this bearish trend to that bull trend to really signify that there's going to be that major buying. Now, I won't do this in this class tonight, but there are ways to really create some major, major buying and selling conditions within the Bollingers, which I've kind of already alluded to it that you can set up major sells on the upper Bollingers and major buys into the lower Bollingers to create some of the best opportunities within the market. Now, I do want to look at Micron really quick because everybody wants me to look at Micron. Hold on. Micron, okay, and I want to delete all the drawings I got here. All right, So Micron here, and I am going to do the exact same thing here with the boxes. We have traded at this range before, so we can say that if we're going to head to this range, if we're going to break this 200 mall, that is going to be a bearish trend. Okay. Until we break that bearish trend, this is going to be in a long-term bullish trend. However, again, we still need to look at the 50-day moving average. And this is where I'm going to scoot these over a little bit. This signifies that example a little better, where within the 50-day moving average, we have the bullish trend up here. And then all of a sudden, what do we see? We're seeing that we're starting to trade within this bearish trend on the 50-day moving average. So within the, quarterly moving average, this is telling us that potentially we still have more downside. Um, However, we do see that the 20 MA is almost at this range. So for us to have upside to break this short-term bearish trend, we have to see the market gravitate all the way back to the 20 MA. And from that 20 MA, we need it to start buying upward. Okay, or else what's going to happen? Back to the lower Bollinger we go. And so it makes it very easy to set up longer term trades this way because this is telling you exactly where the trend is going to go. Um, is it going to tell you the exact penny price action? Not always. Now it can if you go down to these lower time frames. Again, you can go down to the 1 minute time frame. You can literally chart all of this and know exactly what your stock is going to do. However, just using the daily time frames, using daily levels, this is telling us that the short-term quarterly trend is likely trying to be bearish right now. So what is that telling us overall? That very, very likely Micron is aiming for a further bearish downside. Well, what's our further bearish downside other than the lower Bollinger? It's that 200-day moving average. So can we position puts all the way to that 200-day moving average? Not yet, but this is starting to tell you that the market is really starting to keep their eyes on this level. This is a level that the market really is trying to aim for, because if you start rejecting this quarterly trend, if we start heading deeper into this quarterly trend, the next trend is the 200-day. Now, you can again use the 100-day, the 150-day. There are some different moving averages between the 50 and the 200-day moving average, but for me, that's what I like to use. Um, I have heard of some people using like the 75-day moving average, things like that. Whatever works for you to be able to properly identify um, where the overall trend is going. But with the short-term trend, and just 1 second, you're very welcome, everybody. But with the short-term trend, how do we determine what's going to happen? And I want to show, we could show this with Micron. This will be fine here. Okay, we are going to scoot back a little bit though in terms of the days. And I do want to I'll keep the Bollingers there and everything. We're going to scoot back to basically right 317. So for this range, just going to try to block it out a little bit. It's not going to work, but we're still going to try. Just so that's a little darker. Of course, it doesn't do anything. Hold on. Maybe if I make it white, we can just kind of ignore it. Okay, so ignoring this white part, we see that the market price at this range, let's see. So right before the trend changes, okay? Right before the trend changes, what do we see? We see that one, we push the lower Bollinger here. Lower Bollinger being that off of the road, that tells us very likely we're going to be seeing upside. Okay. From the upside, we head towards our closest level, which again is that 5 mile. Now, this is where I'm going to describe the 5 mile weave. And the 5 mile weave is really, would I define this? It would be that the 5 mile is tested between every major level. So if I'm going from the lower Bollinger here, I'm going to be expecting the 5 mile. After the 5 mile test, what should I be expecting? The next major level. So either we're going to be heading back down to the lower Bollinger, or we're going to be heading up towards that 10 mile. We head up to the 10 mile. From that 10 mile, what should I be expecting? The 5 mile again, because that's going to be the weave between each and every single move. 5 mile retested. What should I be expecting after the 5 mile? Either we're going to claim this 10 mile level again, or we're going to push up towards the 20 mile. We push up towards the 20 mile. Okay, what happens after that? Our expectation should be push down, retest the 5 mile. I can guarantee you if I looked at the day, if I looked at like the hourly or the minute time frame on there, I'd be able to see that 5 mile test within that day. So that's very likely a 5 mile bounce to the upside. But from that 5 mile test, what do we expect? Either we're going to head to the upper Bollinger or to the 20 mile, because what's the closest level to us? And I know this is a little hard to see on the screen, I do apologize, but once we're at that 5 mile range, it's telling us that we're going to push to the upper Bollinger, or we're going to start heading down to the next level below us, which in this case, before the 10 mile pulled up above that 20 mile, was telling us that the next level would be downward towards the 20 mile. Well, that did not happen. We pulled all the way to the upper Bollinger. So what happens when we pull to the upper Bollinger? Again, the exact same thing that we expect when we pull to the lower Bollinger. We start going off the road. Once we go off the road, what's the expectation? Back to the 5 mile. Okay. Once we head back to the 5 mile, what's the expectation from there? Either we're going to be pushing back up to the upper Bollinger, or we're going to be taking our next level, which would be the 10 mile. Okay, great. We take the 10 mile from here. What's the next expectation? The 5 mile again. I can almost guarantee you within this session that there was a test on the 5 mile, unless that was that massive gap down. Um, but I'm really thinking there was that 5 mile test within that session. But from that 5 mile test, what's the next expected level we should be seeing? The 20 mile. Okay. From that 20 mile, what is the next expected level? Doesn't show it very well within the candles here, but it should be back up to back up to the 5 mile. See some consolidation. And then from the 5 mile again, what should we be seeing? Well, we have the 20 mile above us, 50 mile below us. Either we're going to be taking that 20 mile, or we're going to be pushing into the 50 mile. We push below the 50 mile, and what is that starting to do? That's starting to pull our 5 mile downward very, very quickly. That's starting to pull our 10 mile downward. That's starting to pull our 20 mile downward. So we're here now, and with us being here, there are a few things to look at. We had a 10 mile test back in there, which that circle isn't going to circle because this is on the daily time frame. I do apologize. 10 mile test, lower Bollinger, 5 mile. Next expectation from here, 5 mile. If I could get the circle right, okay, should be that 5 mile. And if we're going to be seeing upside, either we will be taking the 10 mile again, or we will be pushing to the lower Bollinger again. So that's the full expectation on on Micron is that either the next level is once we test this 5 mile range, we will push above this 10 mile and start heading towards the 20 mile with a few retests in between, or we're going to start really seeing some major downside and pushing back to the lower Bollinger. So that's what the 5 mile weave is that you should expect the 5 mile between each and every major level. And the very, very interesting thing about the 5 mile weave is that it also works on the 1 minute time frame. Okay, it works on the 5 minute time frame, it works on the 30-minute time frame, works on the hourly time frame, works on the 1 second time frame, works on every single time frame. So if you're ever lost of what's going on with your price, look at where your 5 mile is. Okay. From that 5 mile, start looking at where your Bollingers are. Start looking at where your 200 mile is. Start looking at where all the other moving averages are at. And how long has it been since we've actually tested those moving averages? Has it been, that 20 iterations since we tested the 20 mile? Well, within this session, this shows us very clearly, and I want to hide the moving averages for a moment. But within this session, just this shows us very clearly how we have roughly that whole 20 iterations of candles prior to retesting that level. Is that always going to happen? Not always, but on average, this is telling you on average, you're going to see about 20 iterations of length between each of these major tests. So we can use these levels to base a lot of different time frames of trades, whether it's a very short-term scalp, whether it's a very long-term, um, or I don't want to say long term, but a shorter term swing trade, whether it's a long term leap position, doesn't really matter. Each time frame is going to be doing those weaves and using our moving averages in the exact same way. Yes, absolutely. So the moving averages are pretty much within every single time frame, and it doesn't matter. Again, it could be the millisecond time frame, it could be the yearly time frame. The moving averages are always going to be trying to trade the same. Either they're going to be trying to claim this very, very neutral range at the 20 mile, or they go off-roading for a while, and then you look back towards that 20 mile. Which again, on the longer time frames, this allows us to create very, very good positions, both to the upside and downside. On Micron, for example, here on the monthly time frame, this is telling us, okay, we've pushed into the upper Bollinger for quite a while. Let's go ahead and show our moving averages here. We've pushed into the upper Bollinger for quite a while. We have had a 5 mile test in here. I don't know exactly which one's the 5 mile test, but very likely one 5 mile test, and very likely a second 5 mile test right in here. Now, from that 5 mile, are we going to see the extended monthly push into the upper Bollinger here? Or are we going to start seeing our monthly time frame pulling down and cooling down towards some of these supports? Well, very, very likely. When's the last time we've tested the 20 mod? Has it been a whole 20 iterations? Let's go ahead and count it. It's only been about 11. So do we need to test the 20 mod just yet? Not really. That gives us still roughly about 9 whole months before we're going to be testing this 20 mod level. So just using that, we do see that the 20 mile is pulling upward. So what are some positions we could start targeting if we really are looking to buy a very, very long-term position to the upside? Um, we could start targeting this 267-ish range to really give us that major bounce because I can almost guarantee on the daily time frame this would correlate to, yep, towards that 200 mile. That 200 mod generally creates a very, very strong buying opportunity. So, you can correlate your different time frames to show, whether your thesis is correct or not. But for example, if you wanted to, short the very, very top of Micron, Well, if you open puts up here that are out for 6 months, you're probably super, super good on those. I mean, you probably don't even have to worry about those for almost all the entire duration because for the next 9 months, we're expecting to be trading roughly between this range. Okay, so if you had puts for 6 months in there, are your puts ever going to really run out of the money on you? No. Very likely they're going to stay in the money and you're going to do very well on that. So you can use the different time frames to your advantage. I like, again, using the 5 minute time frame for the day trades. It tells me exactly when I need to enter and exit, and I do have a video on that. Um, you wanted me to look at Microsoft. Let me go ahead and take a look at that. So Microsoft daily time frame. I'm going to delete all my drawings because they are no longer important. Okay, so on Microsoft here, what are some things that we're seeing? We're seeing our big, scary, ugly 200-day moving average. We're trading well below that. Okay, well below that. And I do just want to fully mark these ranges. Okay, so we understand that if we see some massive buying to the upside, this upside range right now is roughly back to that 550. Not that I'm expecting massive buying yet, but this is telling us the range above the 200-day moving average is roughly that range. Below the 200-day moving average in a range we've actually traded in is roughly this 482-ish back down to roughly that 340-ish. So we'll put it at that 340 range just to make that a little more even. So our long-term moving averages are telling us that we're very deep in the woods. We're very deep in bear territory right now. Okay, that's fine. But the next symbol we need to look, or the next signal we need to look for is, again, the 50-day moving average. Well, the 50-day moving average actually looks a lot better for us. While we still are within that bearish territory, we are starting to see some support claimed. So we are going to look at this really quick. I want to change this to red just to show with that 20 mile range, it is below the 50-day moving average. We do have our 5 mile and 10 mile below there. So we are within this bearish territory. However, we did just push off of this lower Bollinger. If we can push the lower Bollinger to the 20 mile and from that 20 mile see some upside, then you could start reclaiming some of that shorter term bullishness. However, within the short term, it is telling us that we are within, you know, very, very deep within the woods currently. Um, Even with our upside being expected to be towards that 20 mile, the last time we tested the 20 mile was, I'm just spitballing, but roughly about what, 11, 12 sessions ago. So we don't really need to see this upside for roughly a whole nother week, week and a half. So we're going to be seeing the 20 mile pulling downward very likely, going to be seeing the 50 mile pulling downward, seeing the 200 mile pulling downward, which again, that's just opening our downside further, and that will reduce our upside. As you can see, the Bollinger is starting to pull downward, lower Bollinger is starting to open or expand more to the downside. So the downside on Microsoft is still quite deep, not out of the woods yet. If you see this bounce at the 20 mile, that's potentially giving you the range to head upward, but currently this is telling you that Microsoft is in a very, very strong selling position. And let's go on the weekly time frame just to confirm this. Okay, so on our weekly time frame, we see that the 5 mile is still above the 200, still above the 200 mile, 10 mile is still above the 200 mile, 20 mile is still above it, 50 mile is still above it. So within the short-term time frame, or within the weekly, the 50-week time frame is telling us that we're still far from our upside. Okay. It's telling us that we're very well within our bearish range here on the 50 mile. Now, on the 200 mile here, it's telling us a little bit of a different story. It is telling us that potentially we're still within that bullish upside, but with the 50 mile pulling downward, with our shorter term supports pulling downward, it is telling us that our downsides are really starting to expand very, very greatly. We're seeing the 5 mile pulling downward, 10 mile pulling downward, 20 mile pulling downward. So what happens next is that either one, we have this major bounce at this range, and all of our moving averages start pulling above this 50-day moving average, and we start reclaiming a lot of this lost territory. Or we start seeing all of our short-term moving averages pulling below the 200-day moving average. And once that happens, that really tells you that we're entering major, major bear territory. Um, I really look for the 20-day moving average to be below that, but again, this is the weekly time frame, so that may not happen. But on the weekly time frame, it is telling us that very, very likely, we should be expecting a push downward into this lower Bollinger on the weekly time frame very soon here. Very likely, we are having a 5 mile test and rejection. From that test and rejection, we would be expecting a push back down to the lower Bollinger. So on the daily time frame, that push to the lower Bollinger on the weekly would be what at that 345. And I know I deleted the images, but that 345 on the weekly time frame would be the bottom of that liquidity range that we were talking about on the daily time frame, where it would continue pushing us below that bearish range on the 50-day moving average. So, um, overall, Microsoft still very much in bear territory, and that's not going over any structures or anything. We will do a full class on structures, but just off of the moving averages, this is telling you that we still have a lot of room to go before we start reclaiming anything. Yeah, I've been really saying that too, is that currently the market looks a lot like 2022 to the 2023. Um, it really does look like that bear market. Um, yes, I do expect some upside. Even within the SPY, we're starting to retest that 20-mile range. From that 20-mile range on the SPY, I am really expecting a major rejection to the downside. I do expect the SPY to really start claiming the range with the 20-day moving average falling below the 200 mile. And one of the reasons why we can expect this is that I believe we're already seeing this out of QQQ. So just on the 200-day moving average, we are kind of in between that bullish and bearish point. However, we do have the 5 mile, the 10 mile, and now the 20 mile is slowly starting to pull into that range. But on QQQ, I do believe, and let me go ahead and delete all the drawings. Yep, on QQQ, we are seeing the 20 mile already starting to pull below that 200-day moving average, which is already suggesting that the bearish downtrend should be very much continuing. Very likely we see QQQ do a 20-mile rejection in here, and then very likely back down to the lower Bollinger, which would be at that 555 range. So being able to determine trends from the moving averages is a very, 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 very useful skill. You can look at literally any symbol and know exactly what's going on with the trend. Um, and that's before even looking at the RSI, the MACD, anything else, you don't even have to look at the volume, and you can already tell your levels. And you know that they're going to gravitate to those ranges because it's based off of a moving average. It's based off of where the market constantly wants to move. So, but yeah, that will be tonight's class unless there's going to be any other questions. I did plan on a longer class. I did plan on kind of having a whole PowerPoint and everything, but I did break my hand earlier. Well, I broke a few of my fingers earlier, so it's kind of hard to maneuver everything right now. So I did cover everything that I wanted to cover though. Um, but this is kind of just one of many classes that need to be done. There's still a lot to be discussed within the moving averages and the Bollingers. There's all sorts of different mechanics that can be used with these different ranges. So yeah, with that said, I hope everyone enjoyed this class. Um, if you did enjoy it and you know anybody else who trades who would enjoy it, please feel free to share it with them as I am trying to work on growing my channel right now. So any outreach would be great. Helps me a lot. But besides that, I appreciate y'all taking the time to, watch this class. I do apologize that wasn't exactly how I expected it. Yeah, you're very welcome. Very, very welcome. Um, and again, for me, this was pretty much the main thing that cleared trading up in my head for me, where once I really understood the moving averages, once I understood the Bollinger Bands, trading made so much sense because it was no longer just staring at random candles, wondering what's going on, and trying to look at all these retracements and Fibonacci's and blah 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 blah. I don't care about all that. I care about levels and I care about where the market actually likes to trade at. And these levels are pretty much like clocks telling you exactly where the market wants to go. So if you're good with your clocks, if you can properly navigate these clocks and understand where the market wants to trade, that within 5 iterations of a 1 minute time frame we should be expecting the 5 minute or the 5 mile to be tested, or within 10 minutes of the 1 minute time frame we should be expecting a 10 mile test and things like that, just within every single time frame. So this is a very, very, very powerful tool. Again, this was the thing that really changed me from being a nothing trader to being a very, very, very consistent profitable trader, is being able to look at these moving averages and understand exactly where the price is going to be headed. You're very welcome. Yeah, I know. I'm crazy. I do apologize for that. But with my craziness, it does allow me to see things. So, um, we can all use that to our advantage. But with that said, if there's no other questions, I will go ahead and end the class here tonight. Now, I would usually put out a technical analysis video going over the week, but I am going to go over that in tomorrow's live stream because again, I will be streaming tomorrow in the morning. Um, Basically right at that 9:20-ish a.m. time frame, give or take. And from that, we will go over the expectations and everything for the full week, go over the data, earnings, all that good stuff. But I would usually cover that on Sunday. I'm just in a lot of pain and not feeling super great because of my hand. So, um, let's see. Are you using Webull? Because I know on Webull sometimes and it's very annoying, but it's entirely based on where your cursor's based and where the positioning of your chart's based. So you have to have your cursor all the way to the right to calculate and track the current day. Now, if that's still incorrect, then just make sure you're following the Bollinger Band settings. The length should be 20. This again is going to be tracking your 20-day moving average, or the 20 mile. And the width is setting it, I believe, at a 96-ish% volatility, which is going to be tracking the large majority of those outside volatility moves. So, um, just double take a look at those settings. And with the Bollinger Bands, um, assuming we do get your settings right, I don't want to close this until we do. But assuming we get those all fixed and everything, you don't have to worry about those Bollinger levels too much until you actually start pushing into them. Use those again more so as kind of like the white lines on a road. If driving in America, I don't know how some of the other country streets are, but if you drive in America, usually the white lines on the outsides of the road, you don't want to be crossing over those unless absolutely necessary. And the market does much of the same. It likes to trade within where the road is. So, trading view. I'm gonna have to check. I don't have trading view on my laptop. I have it on my computer, which I have not hooked up yet because I'm still setting up the office. Um, if you're in the Discord or on Weeble, just go ahead and send me a message. If you're just through YouTube, then post on one of the older on probably like my video from last week or something, and I'll be happy to help you get that figured out. But excuse me, with Weeble, I do know that sometimes on the mobile and on the PC as well, sometimes it likes to get stuck on one of these other candles when it should really be tracking the current date candle. So just be cautious of that. I have had the issue on mobile in the past with TradingView where when I go to, and I want to make sure I'm saying this correctly, but when I go to kind of shrink the chart so that I can see everything, it doesn't account for the proper candle because the candle isn't within, um, basically closer to the center of the screen. So I don't know exactly if that's the issue. I do apologize. I don't have an exact answer for you right this second. Yeah, absolutely. We'll definitely get you set up between myself or someone else who uses TradingView. I know Sadus does. It's at SADUS, so he uses that quite often. So if there is any issue, then he might be one of the first to know. Um, but I also will take a look at it on my end as well. So we will make sure we get that solved for you. All right, everybody. With that said, I think we got everything taken care of for tonight. This next week is going to be absolutely wild, so I will try to be on again around that 9:20-ish a.m. time on or tomorrow morning. Uh I do think that the conflict is going to see a full ground incursion very soon here. So hopefully I'm wrong. I would prefer not to see that, but we will go over it all tomorrow in the morning. So thank you all for joining, and I hope you all have a wonderful rest of your Easter evening.